Choosing how to invest money is one of the main issues with personal finance. Whether you have $10, $10,000, or $10 million that you want to invest, the hardest decision is whether to do it all at once, in lump sum, or over the course of time. Dollar cost averaging. So which one is better? Lump sum investing or dollar cost averaging? What is dollar cost averaging? Dollar cost averaging is a method of investing money in equal quantities regularly, independent of market volatility. Investors frequently use this method, for instance, by setting up automatic contributions into an IRA or depositing a portion of each salary into a retirement plan like a 401k. Investing a windfall, such as a bonus at work, a tax return, or an inheritance, is another method an investor may employ dollar cost averaging. The investor might spread out their investments in equal quantities over several months rather than investing the money in one big transaction. What is lump sum investing? Instead of making a series of smaller investments over time, lump sum investing involves investing a sizable quantity of money all at once. Lump sum investing, for instance, is the practice of purchasing a large number of stock shares all at once with a windfall. Lump sum investment can be most profitable when combined with other financial decisions. For instance, opening an IRA or buying shares in a diversified fund all at once are two strategies to invest a significant sum of money while lowering your risk exposure. However, keep in mind that investing involves risk, so you should anticipate your account's value to vary. But which one is better? Lump sum investing or dollar cost averaging? There are several things to take into account because there is no one correct response to this issue. It's crucial to acknowledge that we cannot predict whether investing in lump sums or dollar cost averaging would produce the best results. It's difficult to make predictions, especially about the future. When it comes to investing, it's critical that we are aware of our knowledge limitations. Avoid falling for financial news that contains several market forecasts. A stock market forecast, in the words of Warren Buffett, reveals more about the prognosticator than it does about the future. Even if we were to predict where the market would be in a year, we wouldn't be able to determine whether investing in lump sum or dollar cost averaging would produce the greatest results. Why? Because the result would depend on the market's performance throughout the course of the year. Dollar cost averaging would take advantage of the reduced pricing if it dropped and then climbed. If it increased and then decreased, investing in a lump amount would lock in the lower price at the beginning of the year. Even though there's a lot we don't know, there are several things we may consider to assist us in making a choice. A 2012 research by Vanguard contrasted investing in lump sums with dollar cost averaging. Here is how the study was conducted. Vanguard examined Australia, the UK, and the US markets. Then, it looked at rolling 10-year intervals between 1926 and 2011. Vanguard looked at more than 1,000 10-year rolling periods because they increased by months. It took into account various stock and bond allocations. Vanguard examined timeframes as short as 6 months and as long as 36 months for dollar cost averaging. Vanguard discovered that, after a 10-year period, investing in lump sums outperformed dollar cost averaging around 2/3 of the time. The outcomes were the same in Australia, the UK, and the United States. This study suggests that investing with a lump amount would be the best course of action if you are a numbers person and want to adopt a strategy that would increase your chances of having more money. Some of you might focus more on minimizing your losses than increasing your profits. The Vanguard research also sheds light on this viewpoint. As the study showed, dollar cost averaging produced losses less frequently than lump sum investment during a down market. In particular, the analysis discovered that investing in lump sums lost value 22.4% of the time. 17.6% of the time, dollar cost averaging was lower. Therefore, if asset preservation is your main priority, dollar cost averaging may be the best strategy. Although investing in lump sums often prevails, the gap isn't very wide. After 10 years, lump sum investment outperformed dollar cost averaging by 2.3%. Assuming a 60-40 portfolio in the US. Thus, I don't believe we are discussing significant quantities of money. Even though I really think that every basis point counts, for most of us, this is probably not a choice that will change our lives. When it comes to investing, our emotions may lead us to difficulty. Both when we are terrified and when we are excited, that is true. This can take us in the wrong direction. In its analysis, Vanguard emphasized that DCA may be helpful if the investor focuses on reducing downside risk and subsequent regret. Naturally, any purely emotional concerns should be carefully considered in light of the lower expected long-term returns of cash compared with stocks and bonds, and the fact that delaying investments is in and of itself a form of market timing, which is something that few investors are successful at. An investor may suffer long-term consequences if they go all in with a lump sum investment and the market crashes. Dollar cost averaging could be a better strategy to prevent this. Regardless of how you decide to invest, it's critical to consider both the emotional and practical aspects of investment. You should always have a strategy for your investments. If you want to use a dollar cost averaging method, create a strategy, put it on paper, and follow it religiously. For instance, you may choose to use a 12-month dollar cost average. You'll invest 1/12 of your money in each of the upcoming 12 months. Whatever happens, put your strategy on paper and carry it through. The market's future performance is uncertain. While dollar cost averaging reduces your total risk and might produce more conservative results, investing in lump sums carries more risk and the possibility of bigger profits. The ideal choice for you depends on your financial goals, although each offers advantages, as we have seen. That's all from this video. Which investment strategy would you choose? See you in the next one.